It's a good question. And at least according to one technician, the answer may be yes. Ari Wald of Oppenheimer says last Thursday's record reversal was the signal. Major averages each dropped about 2% or more on that red-hot CPI data before ripping higher and finishing the day with more than 2% gains. It was the biggest point swing for the Dow since March of 2020, more than 1,500 points, and the biggest percent swing for the S&P since 2011, according to Bespoke. Wald says he believes that signaled a, quote, textbook bottom, although stubbornly high bond yields could still create issues in the near term. I don't know why I'm quoting him. He's right here. We can just put him on TV and radio. Ari Wald, I'm like reading quotes from you back to you. Thanks for coming on. How do we know this is all just some giant short covering head fake in a downtrend?
Always possible. You got to look at the weight of the evidence. You know, again, the key reversal day, that's when you have big opening losses that get reversed into the close. That is an indication of downside exhaustion. And it's not just that reversal alone, but what's adding to its efficacy are four things. You know, one, where it occurred. It occurred at a very important level, 3,500 on the S&P 500. That's the 50% retracement of the prior bull market, which is where the majority of bear cycles through history have been limited to. Point two, it occurred with very deeply oversold market cycle indicators, breadth and sentiment levels on par with what we saw in even March of 2009, levels that have been followed by above average returns. Point three occurred with indications of downside selling intensity that was abating versus where we were in June. Typically, that type of divergence occurs at a reversal point. And all this, the final point, occurring with the emergence of bullish seasonal. So this is textbook criteria, Brian. This is why we see an opportunity for the long-term investor. The missing piece, of course, is interest rates, which has really driven this sell-off. I'd like to see that 10-year yield lower. So there is that lingering concern from a near-term basis. But for the long-term investor, we see this as opportunity.
Where's the confirmation signs? What do we need to see?
Well, let's start with the 10-year yield. Watching 3.5%. That was the June peak. So if you fall below the June peak, that's an indication of a failed breakout and exhaustion there in the rate market as well. And on the upside for the S&P, we can consider this counter trend while you're below the 200-day, but you start to move above that 200-day average, and a lot of long-term trend signals are going to flip positive, and all of a sudden you have the emergence of a new bull market.
What would be a sign of failure? And I mean, aside from stocks going back down, of course.
Right. So, you know, listen, there's always the tail risk scenario. And for perhaps you want to, if you're worried about, you can't be in and out, you want to wait for the lagging confirmation, the base and turn. But even just from a trading basis, keep an eye on the June low. It's around 36.37. We're back above there today. We fell below it Friday. As long as we're above it, you have the setup for a failed breakdown below the June low. But what you're going to be looking for, Brian, really is it's not just the level on the downside, but if we start to see selling intensity pick back up and a surge in new lows again, that would have to restart the whole bottoming process.
All right, it's Monday. Let's be in a good mood. Leave us with some opportunity here. Chipotle, CMG, what's on the chart that makes this look attractive to you?